So, jumping into training today, we're going to be doing a follow-up over the last couple of weeks, talking on the VUL product. Today, Ryan's got a client he'll be meeting with actually at the time of the recording this afternoon. We're going to have him run through the presentation. This is a follow-up last week. Joe did the same thing. So, in this case, Ryan's going to kind of walk through how does he present this? How can we maybe give you some feedback? Maybe help sharpen your skills and make sure you're ready to go. You should have the ability to share your screen, and I will mute myself and you go from there.
Awesome. Thanks, Alec. Yeah, so I'm gonna set the stage with my client to kind of share what I did leading up to our meeting. So just for context and for playback purposes, this is a husband and wife meeting with me today that I've been working with for about 6, 7 years. Currently, they just have IRAs with me that I started on Betterment and recently flipped those over to FMAX. And so the relationship is really good. We They have two daughters themselves that are close to my daughter's age, and so we were previous members together at a church, and so that's the lineage of the relationship, and so they're coming in today just based on my follow-up effort to talk about how to incorporate permanent insurance into their situation. Now, the husband is coming to the table or will retire with a government pension. And so I'm not going to go into the specifics of the pension maximization aspect of it. I'm going to kind of keep that high level. I'm going to more present on, kind of the result of my research with the pension max and kind of use the illustration to walk him through this. So yeah, it'll be a slightly different presentation than what we saw last week with Joe, but you'll kind of see my spin on this. So I'm going to treat Alec as my prospect. So today, Alec, you are officially Kevin. So let
Hi,
me
Evan.
share my screen here. All right, everyone seeing that?
Yeah.
Yeah, it just
Awesome.
popped up. Yep.
Cool. Well, hey Kevin, I'm glad we could get together today. I'm sure it's actually been a little while. If you recall, we actually looked at this strategy about 4 or 5 years ago, and I know for you and Cassie, it wasn't the right time in terms of the budget and what you guys were trying to accomplish financially at that time. But I'm glad we could get back together and discuss this because as I just laid out to you, we've laid out kind of the gap that is going to exist if you take your pension and then also have to protect Cassie in case something were to happen to you and that pension goes away. So we've already gone through that survivor benefit analysis, and I'll get into the death benefit design and funding and all that here in a bit. But Kevin, I just wanted to start out really, discussing, when you look at any insurance program, the first and foremost thing you need to look at is the credibility and reliability of that insurance company behind that program. Okay. So nationwide, I'm going to safely assume you've seen a Peyton Manning commercial. Is that safe to
Yep.
say?
Oh, yeah.
Okay. So as as funny as those commercials are, Nationwide being able to pull in a person like him speaks to their financial credibility. And so I think it's important when you even consider something like this, you do have to look at the track record and what that company can do from a claims paying standpoint. And this speaks to those ratings, how long they've been in business and why I've used Nationwide with a number of my clients. So by the way, this illustration is something I'm going to send to you after this meeting. It's 37 pages long. I want to cover today with you the top 5 to 6 pages for you to get a good grasp of how this strategy is and could work for you. So that's the first page that I believe is of importance. The second, how this works. Okay. understanding some of the benefits behind permanent insurance just right out of the gate. So you already know this already, but being that this is a permanent insurance program, this is coverage that it's not a matter of if it pays out, it's when it pays out. And so having that protection long term for if something were to happen now or into your later years, it's there, assuming we meet certain premium and contribution guidelines. The growth potential. So this is a what I consider an ancillary benefit to this program. I'll get into kind of how this program uses variable sub accounts to invest excess cash that you put into this plan. And then from there, we can talk about how you fund it. What I really like about this program and the feedback I get from my clients is how flexible they can be set up, so it's not like a handcuffed amount of money that you're having to put in every month. I'm going to illustrate it that way, but I'll talk through the flexibility in that. Does that make sense so far?
Yeah.
Cool. So these additional benefits I'll kind of touch on as we go, but there are just tax advantages that I actually alluded to you about, that somewhat align with Roth IRA tax advantages that parlays into cash for later. I'm not going to focus so much on the cash element of this plan. I want to focus more on the death benefit and what that can do for protecting your pension. So that's page number two. So I'm going to scroll. Yeah, I'll hit on this one real quick so that when I get into the actual hypothetical illustration, you kind of see where is my money going when I put it into this plan. So this is a nice flow chart. Okay, so you make a payment, and we'll get into that amount here in a second. They're going to take a premium charge off right out of the gate. Okay, that's the equivalent of a sales tax that every insurance company, even down to your home insurance, auto insurance, they all have to levy this tax, and therefore they pass it on to the policy owner. Okay, so I'll get into that specific toward the end. Then the remaining amount from there goes into these variable subaccounts that I mentioned. And we can pick and choose, investment options like you're in your Roth IRAs or, in your 401k. Very, very similar to how you pick funds in that manner. Okay. And then from there, a portion goes towards the cost of insurance of this plan. Okay. So given that this is a non-expiring plan, like a term plan, there are charges that have to be built into this plan to basically for Nationwide to hedge their risk of potentially paying this death benefit, whether it's now or in the future. So they have to assess that and charge accordingly. And then from there, the allocated funds can build value, and we can talk about how that builds value. I said that wasn't going to be the primary focus. It's really about the death benefit and what this could do for protecting your pension. So, any questions or anything so far that I've covered?
I feel like the numbers maybe will help me understand this better.
Perfect. Yep. And I'm a numbers person too. So yeah, so I'm gonna scroll through, like I said, 37 pages. I want to cover the high level stuff. So I'm gonna scroll down here and get right into the meat and potatoes. All right, Kevin. So right out of the gate, we have to look at both your age and your potential health rating to acquire a plan like this. So with your birthday being next month, sorry, but the insurance industry considers you already 43. So that's just the way it is when you present one of these illustrations. I'm showing you at a what's called a preferred non-tobacco rate. So this is the second best rating that Nationwide gives their policyholders. So there could be a better one achieved, but knowing you and what I have gathered about your health background, this seems to be a conservative estimate of where that rating would be, and that rating ultimately dictates that cost of insurance. Okay. So what I did, like I started out our meeting, is presenting where this death benefit needs to be at the time that you ultimately retire. So I know with your trajectory and when you can pull your pension from the government, that's around age 57. Okay. And so what I did here, you see this death benefit right below your name and age there. It says 150,000. Okay, so I'm choosing that death benefit, but then I'm also choosing what's called a increasing death benefit option. All that means, Kevin, is every dollar that you put into the plan is added to that baseline death benefit and grows with the time that you are in the plan. So, said in another way, every dollar that you put in minus the costs that we talked about plus growth gets added on to that net death benefit. And so you can look at any year, any hypothetical scenario, and that's what Cassie would get, or your estate, whichever one. So common question I get with these plans is what happens to the money I put into it, right? And so the increasing death benefit is a optimal manner to design these plans so that you're getting everything you put in plus that initial death benefit. Does that make sense?
Hmm.
Cool. So, as you see here, what I'm showing here, as far as a initial amount going in. So I just told my software, hey, solve this policy, or solve this plan such that it can be funded at an amount that basically keeps it going, into your retirement years. I'll scroll down in a bit and show you what I mean by that. So I'm actually telling this plan to stop making contributions after age 65. Now I realize you will have retired at that point, but what we want to do is make sure that there's enough runway built behind this plan so that there's some cash accumulation there, and then that death benefit is really just icing on the cake when it comes to protecting that pension in retirement. So, as I showed you earlier, the cost to your survivorship plan, if you chose the one that you need to, is it's about $200. And so that's obviously not a cost you're feeling right now, but it will be at the time of retirement. So I wanted to connect that dot with you in terms of that's a future cost, and a way to think of this plan is you're going to get ahead of that cost, and basically I think of it like pay now versus pay later, right? So if you could pay this now and kind of provide this protection at this age, at your health now, you don't have to worry about paying that additional $200 to protect your pension when you retire. Do you follow that?
I do, yeah.
Okay. So that was the main objective is getting to a death benefit at around 57 that if you if that, paid out to Cassie, you could essentially turn around, invest that, and replace the income that was lost from your pension. And so um, I've set up a just a single income annuity calculator that I can also show the client to say, hey, if you plug in this one-time amount, here's a guaranteed amount of income that will be spit out for the benefit of Cassie. And so that is something that I would show during the meeting and kind of complete that pension maximization description. So yeah, Kevin, this is really, like I said, all about that death benefit and designing it with, that end goal of kind of making up for the lost income should you pre-decease Cassie. And so I want to get into the cost because I know that's a curiosity of yours, but anything before I move on from this page that you had a question on?
Uh, is this money that I'm putting in, is this gone for forever? Or do I get to like access it?
Great question. So, um, definitely not gone forever. So we obviously have the costs associated with operating this plan, and I'll get into that here in a moment. But you see that cash value column? That's the amount of, think of this like the equity in your home. Okay. So when you start funding this plan, think, just look at year one, right? You've put in about 2,500 bucks and 1,500 is what you have to show in equity. You follow that?
Yeah. Yep.
Okay. So as time goes on, you'll see that that amount is trying to catch up to what you put into it. And it's about year 14, 15. It's pretty close, to that age or time frame rather, where you can kind of see that cash value starts to eclipse what you've put in. So I first wanted to make sure you understood, you're funding this in a manner that is, building equity in the plan, but it does take some time, just like it does in your, with your mortgage. Most people, when they first buy a house, they realize like most of their money is going towards the interest, and it takes sometimes years to feel like they're making any progress on that principal, right?
Yeah.
And that's a very similar trait of this program. As far as your question about being gone forever, so no, at any point you look at that cash value, and of course this is a hypothetical. You see that assumed rate of return in that right hand um, column there. It says 7.43% net. So that's an assumed interest rate that we're using based on the mutual funds that we've chosen. So that's the rate that we're growing this cash value. And then at any point, you have access to that cash value. Generally, in the first, I say, 4 to 5 years, um, this isn't money that I would, bank on touching. You really want to let it incubate and kind of get going. But at any point we can tap into 90% of that cash value and be able to take that for one-time purposes. You can take that on a withdrawal. You that's equity. I mean, think of it like a HELOC, a home equity line of credit, but it's a loan that you don't pay back. Does that make sense?
It does. Yeah.
Okay. So definitely not gone forever. But it is, like I said, one of those ancillary benefits to having some equity being built in this plan, that, say you're 60 years old, you've got 52 grand in this plan. And oh, by the way, that's tax exempt money. There's no taxes due on this plan because of how the IRS has titled these plans. They're well aware that these are being used by many investors and savers, and so they have placed their guidelines around how much money can go into these plans. And so we're not trying to max fund this policy by any means, but hopefully that helps you understand, kind of the accessibility and what your money is doing from the equity standpoint. So it's kind of like you have two values to the plan. You've got the equity, and then you always have that death benefit. You tracking with that?
Yeah.
Cool. So to wrap up, I do want to hit on the costs. I think it's really important to not only just see it, but know why Nationwide is so competitive in this space. So I'm doing a lot of scrolling, but like I said, I wanted to hit the 5 to 6 most important pages. So it's all the way at the bottom here. So just to tie up everything we've talked about up to this point. So you see the same amount that I just showed you earlier, 2,500 and some change going in per year. And then if you just follow me, column by column here, you've got the premium charge, which is assessed against money coming into the plan. So again, that's like a sales tax. It mimics a sales tax for the insurance company that they pass on to the policy owner. Okay, so that's a cost associated with money coming in. So you see when money stops being put in, that cost goes away. Okay. Your administrative charge, I kind of just say it is what it is, $10 a month. Not a backbreaker from a cost standpoint. The big one, as you can see, is this per 1,000 of specified amount charge. This is the amount that Nationwide is charging policy owners to protect themselves in case of paying this policy out too soon. Okay. So again, going back to my very first point, this is a permanent plan that has every bit of 100% probability of paying out, right? And so to hedge that 100% probability, they have to assess this charge to basically get ahead of that risk. And what I like about Nationwide compared to some of the other carriers we work with is they kind of get that charge out of the way. And you can see the first 10 years, there's some providers we work with that'll drag that charge out a little bit longer. And so it's kind of like just, paying the piper, right away. It's 800 bucks each year, and once you're done paying it, you're done paying it. And so it is kind of just the cost of having permanent coverage, in other words. And then you keep going over, you've got a cost of insurance, which is its own separate cost. You can see it goes up every year, by a nominal amount, because permanent insurance, the way they assess your mortality is it changes every year. And so it's rising in cost because of every year you're older, you're statistically closer to passing away. So I'll get to that conditional credit endorsement here in a minute. You can see that there's a positive amount added to your plan at year 16. But then to finish out the columns, you've got your interest earned, which is that hypothetical growth that we're getting through the mutual funds. And then all the way to the right, you see that cash value, which is the same column we looked at earlier. Okay, so circling back to this conditional credit endorsement, this is kind of a bonus that Nationwide puts into their plans. It's kind of a hey, thanks for being loyal to your plan and to us. There's a calculated method to the way they come up with that amount. But what it's cool about it is you can see, being that it's right next to your cost of insurance column. I can scroll through here. You can see here it helps offset your cost of insurance, as time goes on. Not completely, but it kind of softens that cost for sure. And again, this is unique to Nationwide. We don't have any other provider that gives this, just additional kind of credit to the plan on top of what the investments are doing. So yeah, just to kind of finish out the cost ledger here. Like I said, we've stopped putting money into this plan and it is still growing. Okay. You can see that your death benefit um, at the time of stopping putting money into it, I've actually stopped it from going up, right? I told you how it was increasing, but you don't want to do that for the life of the plan. You want to at one point or another, level that off. We've kind of achieved the pension protection that we set out to do with this plan. And so that helps control that cost long term too, is you don't need to be paying, for an increasing death benefit long term. So do these costs make sense? Anything stand out as a question or concern?
No.
Terrific. So yeah, like I said, these were the top 6 pages that I wanted to highlight out of this whole 37 page document. Obviously, it's this length because we've got compliance and lawyers and all that stuff to make sure is in check. So you're going to get this full document um, by way of a follow-up email from me. But when you go back and look at this, I want you to kind of remember the top 5 or 6 pages that we reviewed. So does that make sense?
Does.
Cool. Well, I'm glad we could get together today. I want you and Cassie to like I said, go home, look at this. We'll get back together and see if this makes sense for your situation. Sound fair?
Cool. Sounds good.
Cool.
All right. Any feedback?
Um, I really like the comment you made about, the whole paying now or paying later thing. I think that's really something simple for people to wrap their head around about, what it costs to have a survivorship option later as opposed to now, and how doing it now is also, uh, you know, in the case of VUL, and as we talk about often as an inflation hedge too.
Mhm.
So kind of a double win there, right? You're getting it out of the way now while your income's a little higher. You don't got to worry about it later. You're building this cash flow. Yeah, that was a really good way to put that. I'm curious, just in the scenario overall, that death benefit doesn't seem very large for someone that's going to have a government pension. What's the
Yeah.
reason for that?
Yeah. So his pension is only going to be around 3,000 a month.
Oh, okay.
Um, and the way the civilian pension works is he's going to have to take at least some. He's going to have to take a survivorship option of some sort to carry the health care or health
Hmm.
insurance into retirement. So it's kind of a caveat that I've learned with civilian pensions.
Hmm.
Um, so he has sent me his pension estimates prior to, just in previous annual review. So I basically looked at the delta between, okay, what's the cost difference between 100% survivorship, um, and 50% survivorship, which by the way, aren't dollar for dollar when it comes to replacing his lost pension. It's kind of tricky when you hear those 100%, 50%. You just think like, yeah, that's what his wife is going to get, but it's not the case. And so I was using um, the the difference in those two plans, and that's where I refer to the cost being about $200.
Is that if he did the 50% survivorship?
Yeah.
Okay. So you're getting them the bigger check that they're able to get today because they're required to do something of a survivorship option. So that allows for us to plan for a smaller policy, less money needs to go in. So that was a question that I kind of had, but yeah, that works.
Yeah. Yeah, so the way, and I mean, maybe I'm oversimplifying it, but I've just used a simple income annuity calculator that I found on a Charles Schwab website, and it allows me to put in, both husband and wife if I'm planning for joint income. It tells me the start date, which would be the day he retires. So kind of planning for if, God forbid, he passed away the day he retired. And then it tells you, okay, do you want to know how much monthly income is needed or what an initial amount invested into a annuity is needed? And so that's where I plugged in, about 190 to 200, and that's what spits out, the replaced income from his lost pension. That's what I will end up showing in my meeting.
Okay. Yeah, fair enough. I the like one thing of feedback that I have, and this is reflective of myself too, is how can we be more conversational when we're presenting something like this? It's a very long-winded, I'd say this and like a variable annuity can be very long-winded. So how can we be more conversational? I feel like Tyson's really good at doing that, injecting questions along the way, but then relating it to what they already know. So it gets them like, hey, you remember you told me that the cost of the survivorship option is going to be about $200 a month. Yeah, okay. Hey, here's how this kind of relates. So injecting points into how you're presenting it keeps them engaged. Otherwise, this is just across the board. If we're just kind of rambling on about a 37-page document, we're going to lose everybody. So
Hmm.
I think how can we be interactive? Just overall, that's a general feedback.
Yeah. Yeah, I think it's it's a little harder to role play that.
Yeah,
I mean, sure we could. Yeah, no, I'm point taken for sure. That's why I tried to stop at least intermittently to, get the proverbial does that make sense? I mean, that's been my go-to for a while now.
yeah, yeah,
I thought it was explained really well. I actually like how you started with the first couple pages and really broke down what this policy was for and how it works. That was
Mhm.
really good. Something that I'll definitely go back and watch.
I've never done it that way, honestly. I thought just, 10 minutes before this call, as I was thinking, I've looked at these illustrations multiple times over, and, one of my like initial things is like, gosh, this thing is so many pages. Like, so I want to be upfront about that with the client. Like,
Hmm.
hey,
Yeah, no,
this is a long document. I want to
yeah.
go through the top 5 to 6 pages that are
yeah,
are going to be important.
I think it was really good. And honestly, and again, I know it's difficult on the role play thing, but like I see absolutely zero wrong with highlighting a few of those things on those first three, first couple pages and just because, it's the remembrance of like you can get into all the nooks and crannies of these things, but on a surface level, that's what, you need to be able to explain to these people. So I thought that was a good takeaway.
yeah. Yeah, I think too, knowing what your client is maybe what their hot buttons are, what their concerns might be. You
Mhm.
can get that out of the way on the front end. So,
I do
when
have a policy question, like though this is like a general question. So I noticed on when you were doing that, it says no different or when it was talking about like how everything works and what I wrote down was what's the difference between a tax-free loan withdrawal and it also says no penalties if over 59 and a half. So I think a question that might raise is like, well, wait a minute. I thought you said if I got to be 50 years old and wanted to buy the Florida condo, I could take some money out of here.
Mm.
So that's just for my own knowledge base, is that would be in the form of a loan or what?
Are you talking about accessing the VUL prior to 59 and a half?
Yes.
Okay. Yeah, so one would depend on the age and
Well,
you know,
we've we've used this thought process with people, on explanations before, and like, that exact thing. If you want to go buy the ski shed or the down payment in the Florida condo when you're 50, 55, whatever, you can access the cash value. How do you do that without penalty if it says on there that you got to be 59 and a half?
did you catch that in the illustration?
It was on like the very one of the first two pages that you were talking about how it all works.
Okay.
Yeah. Ryan, can you pull up the illustration
Yeah.
again?
Yeah.
And
Yeah.
maybe I could have read it wrong too, but
Yeah, let's just take a look.
I think it was kind of where they had like the two boxes that kind of break down and the other five kind of deal.
Oh, this one?
Yeah. So, okay, no, maybe it was the one before this, either before or after. There you go. Tax advantages. No federal tax penalty for early withdrawal before age. Oh, no tax penalty. Okay.
Yeah.
Well, there's the answer. Okay. Never mind. But that's good. That's a nice page.
Yeah. Yeah. And like I said, I actually have never used this page when I actually most most of the time I did, I go right to the, current current rates, assumed rate of return like you did, Joe.
Yeah.
Um, but
I just
for
think this does a really nice job at setting the stage for what you're going to talk about. And it helps you parlay into, kind of like just that. You set the table for what we're going to talk about. We're going to talk about the five, six really important pages, but kind of just wanted to do, like Alex said last week, kind of a 50,000 foot overview of what we're going to kind of talk about here so that,
Mhm.
you know, you can tie it all together at the end. I think
Yeah.
that I find that valuable.
Yeah, I think the one thing that I would maybe caution on is if you're using these pages, there's so many words that I would maybe address. Hey, I don't want to park here for too long. There's a lot of words. If you start trying to read this and I'm explaining something, we're going to get lost real quick. And so there's a couple key words on here that I want to point out to. So if I was on Zoom, I'd be highlighting, hey, I want to talk about growth potential, or I'm going to explain that and how that works, what it looks like, flexible premiums. I want to explain, why I really love flexible premiums over required premiums, tax advantages. I'm going to walk through how taxes are implied over this. But ultimately, these are benefits to you, the client, that I want to explain how this gets implemented over time. But I just wanted to show you this page. We're going to highlight some of those key concepts when we walk through the numbers here. I'd maybe just spend that much time on it.
Yeah, I really, I mean,
If
yeah,
you get too
that was
wordy,
gold.
yeah, if you get too wordy, I'm gonna be like,
Hmm.
okay, well, flexible premiums with VUL, you can make. Why is Ryan talking like I can't think right now, and and that's the same thing when we're doing like when we give these talks, where we do a PowerPoint slide, I have a couple key phrases on there. It's not a paragraph, so how can I get the information to my client, but I'm not okay. Well, let me stop. I'm gonna let you read this, and then I'll start talking again because that gets really choppy. Um, but then like if I was in person, I'd be pointing at the screen, I'd be touching it. Hey, we're going to be doing we're going to talk about these couple things.
Yeah.
um, but I think that hey, I wanted to show you this to give you a frame of reference of some of the high level things that we're going to talk about. This is going to get detailed, but I want you to follow along. I want you to know that there's be flexible premiums. We want to grow your cash value in this. That's ultimately your benefit. And hey, I bet you don't like paying taxes, right? Hey, I want to show you how this is going to be an advantage for you tax wise now and in the future.
Hmm.
And then you say, hey, like you like those advantages, right? Yeah, cool. Hey, I want to show what they look like now.
Hmm.
You dive in, and if I'm nitpicking, I what I what I wouldn't want to do if I was presenting, and what I wouldn't want if I was a client, is you to be like, hey, there's 37 pages. Like I'm just going to skip over 30 of them. I would maybe address, hey, this is pretty long. Hey, I just want to show you they show you like three very hypotheticals that takes up like 20 of the pages. So what I'm
Hmm.
showing you is an average rate of return of 7.5%. I just want you to know in the last 12, 36 months, like my clients are averaging a 12 to 15% return. So we're blowing these numbers out of the water, but this is kind of a baseline. The other hypotheticals are a 0% rate of return and like a 2%. So we're going to do better than that. But for compliance purposes, we have to have that on here. Or
Hmm.
what are some kind of different breakpoints? But I don't want to spend time because when's the last time the S&P 500 returned at 0% over a 20-year time frame? They're going to be like, I don't know. Or they're going to be like, well, never. And then you can just say, hey, it just has to be here for the insurance industry, but that's why I'm skipping over it. And so you address it in 30 seconds, but you get them to be able to see, hey, I'm not trying to hide something from you, and we can move along. So you're addressing that this is a long thing, a long illustration, but you're not hiding something from them.
Yeah, good. It's good. Thanks, guys.
Does he have potentially more money to put into this thing or no?
That's what I need to kind of feel out.
Because it really looks cool too when that conditional credit endorsement can overtake what the cost of insurance is.
Right, right. I know.
I mean, even like what it would do at like, 250, 275 as opposed to the 212 or something.
Yeah, yeah.
And for you, Ryan, I think especially in some of these, what I've found that's more valuable, what it's more valuable to have like your illustration software pulled up as opposed to a PDF illustration. Because
Hmm.
I like just like when we do the FMAX proposal, I say, hey, I want to take you behind the scenes, get under the hood of how I build stuff, what
Hmm.
it looks like for me as the advisor. I'd be doing the same thing. So for this pension max case that Tyson and I had just done for a client, we pulled up the software and we just said, hey, this is a rough draft. This is exactly how we build these things. We just crunch numbers until we have one that works. And so
Hmm.
we let the client say, hey, year one, what do you want to put in? Crunch those numbers in, calculated it. Hey, that doesn't work. We need to put more in. And we just let them do that. Where I think when you're doing this, it's a little more finalized, where
Yeah.
you can when it's just the software, now you have on the left side of the left column, it's you can click as opposed to scrolling 20 pages. It makes it quicker, but then you can also say, hey, in this case, this is what we're trying to do is fully maximize your pension, relative to the survivorship option you're getting. So if we're younger, we're on the front end. Is your cash flow higher, or do you have a mortgage that's going to get paid off in 5 years? I want to calculate in here how we can get this thing as robust for you as possible. So let's kind of teeter back and forth how we can personalize this. And I think those subtle things will make the client feel more comfortable and understand why we couldn't do it, like you said, 5 or 6 years ago, whenever it was, why it's maybe a better time to do it now, and how we can maybe enhance it in the future. Hey, we've got a kid in college that we need to just get through, paying the, tuition. And then from there, we can really, jack this thing up and put more money in. So I think those things just make people feel even more part of the process.
No, I like that. Just inviting them into the proposal stage rather than it being kind of like a final drafted illustration. Yeah.
Cool. I feel like we probably hit the nail on the head on giving you some feedback. Your meeting's at 2 o'clock. Is that right here?
Not till 4:30.
Oh, 4:30. Okay. Well, we got a little bit of time. So, yeah, I mean, you did great. And now it's just a matter of taking a little bit of feedback, but just continuing to be that more prepared and ready to go. And I bet you're going to do just fine. We're going to hear a really solid update from this next week. So I'm going to stop the recording here. Sure you want